So, in this lecture, we'll be learning about effective cash flows. So, most of us think that we mess up valuation because of the discount rate. Is it right or wrong? It's wrong. We mess up valuation more because of cash flow. We need to calculate accurate cash flow to arrive at a right decision. So, here are 4 steps you should know before you do a valuation of a company. Step 1. Calculate right earnings. How to do this? Start with the latest numbers. Look at the 12-month trailing numbers and not the previous ones. Next, you need to fix your accounting issues. If you are acquiring a land or a store or even an equipment for a long term, treat it as a debt, not as a rent. It should be treated as a loan. Same goes for R&D. R&D is not a regular expense. It is a one-time expense. So treat it as an investment and spread it across 4 to 5 years and treat it as an invested capital. This will help you come at an accurate number, accurate starting point for an valuation. Step 2. Tax rates. There are 2 types of tax rate, effective tax rate and marginal tax rate. So effective tax rate is the tax you pay in average. Next is marginal tax rate, the tax you pay for the every next rupee. So when you start doing valuation for the starting years, use effective tax rate and next gradually shift to the marginal tax rate to get your forecast realistic and accurate. Step 3. Account for reinvestment. Cash flow is not all profit. They also take into account the reinvestment a company does. So here is what to subtract. Net capex, which is capital expenditure minus depreciation. Change in working capital. Then add capitalized R&D and acquisition. Don't take into account the cash or short-term debt. They are not much effective. Step 4. Get free cash flow for equity. So here is how you come to a number. You should subtract the investment as well as the debt repayment from your net income and add the new borrowings you have made. So here we come at the number which gives you free cash flow for equity. This is evidently the cash left for dividends as well as buybacks. So here we come to a conclusion. Here we end the 4th point. So at last I would say that don't worry much about your discount rate but worry about your cash flows. If your cash flows are not right, your valuation is trash. So everything comes later but the cash flow comes first.